Welcome to a lecture series in Fundamentals of Accountancy, Business and Management. Fundamentals of Accountancy, Business and Management is a specialized subject offered to senior high school students enrolled in the Accountancy, Business and Management strand under the Philippine curriculum. This subject is especially designed to equip them with the fundamental and basic knowledge in accounting. That being said, the students will be given a walk through the entire accounting process up until the point where they would be able to perform interpretations of financial information. After which, the students would also be taught the basic principles in taxation, which will further to the topics in income taxation and business taxation. So from here, let us now begin with the first lesson of our lecture series. Let us be introduced first to the concept of accounting. At the end of this lecture, we should be able to have a substantial understanding of the concept of accounting by defining it as a language and as a process. So let's start. Before a student will develop the joy in learning this subject, I always tell them to first memorize and understand by heart the definition of accounting. There are so many ways on how to define accounting. 1. Accounting is referred to as the language of business. It is the language of business because it is the medium of communication between the business entities and the interested parties to its financial activities. In this definition, there are three important elements that must be taken into account. First, the purpose. Second, the parties. And third, the subject. The purpose is to communicate the financial information that the business will be able to gather and summarize into a report called financial statements. The parties would be the business firm and the interested users. The business firm is the one responsible in preparing the financial reports, while the interested users are other entities, firms, institutions, or organizations who will make use of the financial reports in making economic decisions. Generally, interested users are divided into two. We have what we call users with direct interest and users with indirect interest. Users with direct interest may consist, but not limited to, the management, investor, or creditors. Investors are interested in knowing the capability of the firm to earn profits in order to be sure that the capital they are injecting to the firm will become a profitable investment. A creditor will do the same. It will take a look at the capacity of the firm to pay its obligations using its available assets. The management is also interested in knowing how well the firm performed during the last accounting periods. On the other hand, users with indirect interest may consist, but not limited to, the government, employees, and the customers or clients of the firm. The government is interested in the capacity of the firm to pay its tax obligations. Employees may be interested to know whether the firm has sufficient asset to pay for their salaries. Clients or customers, especially the regular ones, may also be interested in knowing whether the firm can still keep up with the quantity of products that they regularly buy. In its simplest sense, all these entities, firms, or institutions are interested in knowing all financial information that will guide them in making economic decisions. Finally, the subject of accounting, being a medium of communication, is financial information. Financial information may be presented in the form of reports, which will be prepared by the firm and may be made available to the interested users. Another way to define accounting is by citing the definition given by the American Institute of Certified Public Accountants, or the AICPA. According to the institution, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character and interpreting the results thereof. To my mind, this definition is comprehensive and complete. It has substantially mentioned the phases that need to be performed in the accounting process, namely recording, classifying, summarizing, and interpreting financial transactions or information. Also, worthy of our appreciation is the fact that accounting is also considered an art. Not that kind of art that we are going to paint or build sculptures. It is said to be an art because just like other artists, accountants must also be flexible in devising solutions for specific problems in the business. An accountant must be critical in performing the accounting process, bearing in mind that a single mistake in the earlier parts of the accounting process may multiply to more substantial errors in the subsequent processes. That's the reason why aspiring accountants must, as early as practicable, develop their critical thinking skills. This is not only for the reason that their integrity or the integrity of the profession is at stake, but more importantly, the welfare of the business. Accounting in its entirety is also considered a process on its own. It is the process of identifying, recording, classifying, summarizing, and interpreting financial data to make into a financial information intended for future economic decisions by the business. This definition will now link us to the next part of this lecture, understanding accounting as a process. In order to make our understanding in the accounting process systematic, it is important to memorize the phases included therein. In this presentation, you can see that the accounting process starts with the identifying phase. This step involves the identification of transactions that are going to be recorded in the books or journals of the business. Bear in mind that only business transactions are recordable. Transactions that are personal to the owner or owners of the business are not considered business transactions, thus not recordable in the books or journals of the business. In the next video, we will discuss the criteria followed before a transaction is considered a business transaction. So do not forget to watch the next set of videos. The next phase is the recording phase. This is the point in time where business transactions are going to be recorded in the books or journals of the business. Business transactions, when recorded, will produce now what is called journal entries. Once recorded, the next phase that we need to perform is the classifying phase. This is the point where journal entries will be classified and posted to their respective ledger accounts, prepare year-end adjustments, prepare an unadjusted trial balance, a worksheet, and an adjusted trial balance. Did this part overwhelm you? Don't worry. You will understand this more when we already answer problems that related to this topic. After classifying, we are now ready to prepare the financial reports, substantially consisting of an income statement, changes in equity or capital, balance sheet, cash flow statement, and notes to financial statements. This phase is called the summarizing phase. Now that we have prepared the financial reports, the financial information is ready for interpretation. This is the very last and most important part because this is where we will be able to give meaning to the financial figures, which interpretations are the very basis of the economic decisions that will be made by the interested users. This is not the end of the process. Take note that accounting is also a cycle. Therefore, after performing all the phases in a particular accounting period, the process must be repeated. As long as the firm exists, the accounting process will be periodically performed. So that's it for the first part of our lecture. I am hoping that this lecture somehow tickled your interest in accounting. See you in the next part of this lecture series. Bye!